Imagine this situation, waking up one morning and finding out your hard-earned money invested into the stock market is down by 80%. And what could make it worse? Your stock market or your assets never truly recover or bounce back. No, this is not fiction. It is a reality of people in Japan, and it has been the same way for the last 30 years.
Japan seems to be an example of what we don't want to do and what we don't want to become.
Japan's economy has been stuck in neutral for basically the past 30 years.
Japan is no longer the world's third largest economy, and it is officially in recession.
But wait a second, everyone, including you and even me, we are expecting 15 to 18% CAGR in our portfolios over the long term. Let it be, take any video on the internet and you'll be seeing everyone saying at least you should expect 12% returns from the Indian stock market. And they add these two terms, which is over the long term and based on historical data. And it is true, a lot of economies and stock markets have performed amazingly over the last 100 years. Even if you are looking at the Indian stock market, it has been a phenomenal growth story ever since BSE was introduced. The US also has the tech-heavy Nasdaq, which would have made you a huge millionaire if you had invested in it in the 1980s. But in all of these stories, they forget about this one situation or the one elephant in the room, which is the economy and the stock market of Japan. In the year 1968, Japan was the second largest economy in the world, and it was even projected to surpass the GDP of the United States of America. Their economy was so large that despite all of the trouble they had in the 1990s and in the 2000s, China became the second largest economy in the world only in the year 2010. So let me bring some agenda and context into this video. So the first point we'll be discussing is what really happened in Japan that is today being called as the lost decades of the country. The second is why did it happen? What were the circumstances it happened in? The third is will it or can it ever happen to India? And 4, I know all of you are coming here for the most practical finance content in India, so we'll be talking about what you can do to protect yourself from such a situation. Yes, those are the agenda topics for the video today. So without further ado, let's get started. This is Ajay Ajith. Welcome to Market Feed. So the first point is what really happened in Japan. And in order to discuss this, I would like to present it in the form of a story. So try to imagine this in the way it happened in Japan. Now, please do note that it will be very largely simplified, and we'll be discussing only topics that are relevant for a stock market investor. So let's get started. 1945 Japan, the entire country and its economy were completely destroyed after fighting World War II against US and its allies. So from here, it was 7 years of occupation by US in Japan, right? So they were completely controlling the country here. So at this time, the US thought that, hey, this is a good opportunity to show off capitalism to the entire Eastern world. Yes, the Western world had started adopting it, and the US felt that even the Eastern world, even the Asian countries needed to know the power of capitalism. So why did they even do this? Why were they trying to promote capitalism to the Eastern world? So in the 1940s and even into the 1950s, Soviet Union was a major superpower in the world. And when the Soviet Union rose to power, it created largely two schools of thought. One where with the communist and socialist way of growth, which was showcased by the Soviet Union, and on the other side, the capitalist and the liberal side of growth, which was showcased or portrayed by the United States. So in 1949, they did a very important thing. They set the value of Japanese currency very low against the US dollar. I'll explain what happened here, do not worry. And the US did this because they wanted Japan to be an amazing example of capitalism, especially under the guidance of the US, where they become such a successful and huge economy. Right? And this was what happened in 1949. I'll give you an example to think of or understand this implication. So even in the Indian example, we know this. Whenever the rupee's value is falling, whenever it is getting devalued or it is falling and falling, the prices of our imports get more expensive. Right? So whenever we are trying to import, let's say crude oil, gold or whatever else, the prices of these imports keep getting higher and higher. But in this scenario, when an Indian company is trying to export its goods and services to another foreign country, because our value of our currency is so low, our prices will be highly competitive in that foreign country. You can imagine the example of companies like TCS and Infosys exporting their IT services into the US. They are highly competitive because over the last multiple years, the value of rupee has only kept on falling. And the same logic was applied by the US in the year 1949. They set the value of yen very, very low so that their imports from Japan into the US would become very cheap. So the people in the US would start buying all the goods and services that Japan is producing, and Japan's economy will grow, and they'll be the poster child for what is being called as capitalism. And so US, wanting to win this race of capitalism versus socialism, they tried to promote this capitalist idea across the world, and they were also fearful that communism was taking its roots heavily in the Asian countries. So that was why this stance was taken. And do keep in mind, this was much before the floating exchange rate concepts that we see today, and the US was found it very easy to set the Japanese yen's value. So after doing all of this and setting the entire plan in motion, the US leaves the country. They pack their bags and they leave the country in 1952. And what followed for the next 2 decades, 20 years, was a period of amazing growth for the country. Nearly 10% average growth was seen in Japan over those 20 years. In between all of this, the country and government of Japan took a lot of intelligent decisions. They decided or instructed that the Bank of Japan should be focused on giving out loans to strategic sectors that can grow the country over the next 10 years. And they made sure the industries of the future, shipbuilding, coal, energy, and even mining, they got all the resources, the loans that they needed so that they can continue to expand and grow. Between 1952 and 1985, those were the golden years for Japan. Everything was happening very smoothly. There were books written about how the Japanese way of working and the Japanese companies' mindset were reshaping the entire global economy. And some even predicted that Japan could soon overtake US in terms of GDP numbers. Between the years 1952 and 1985, the stock market in Japan rose by nearly 6,000%. And guess what was the real life situation of all the people in Japan? With such an economic boom, everyone was happy. Brands that you know today like Sony, Mitsubishi, Toyota, Canon, Nikon, even Nintendo, they all came out of this time frame in the Japanese economy. So the population was very happy, the government was very happy, and the US was also very happy. We'll get to that point, that their example, what they wanted to show to the rest of the world, that was really working. And once again, it was proved that capitalism was a working theory. The trade surplus of Japan in the year 1986 was $82.6 billion. Imagine, that was a trade surplus that they were making. India, even today in 2023-2024, they had made a trade deficit of $88 billion. Imagine that Japan 30-40 years ago, they had a trade surplus of that same amount. Just imagine that. Imagine how powerful they were as a nation back then. And then came a stop to all of this excitement. So a very fine day in 1985, the 5 largest countries at that time in the world, they met at New York's Plaza Hotel. So US, UK, Germany, France and Japan, they all met at this Plaza Hotel and took a decision which is called today as a Plaza Agreement of 1985. The United States felt that the dollar was too strong of a currency. They felt left out, or they felt cheated, because their exporters were not able to compete. Even their domestic companies were not able to compete because of the very strong dollar. So again, remember what was the trigger point for Japan's all the success over the last 20 years? It was because of the very low fixed rate of yen or Japanese currency that they had set in 1949. So the US felt like it was no longer a fair playing ground, that everyone had a lot of fun, and it was a time to stop the excitement. So the United States, being the bully that they are, they threatened trade war on all of these countries if the US dollar did not get devalued. Right? The same situation that they had made Japan go through all those years ago. right? They wanted to do in the US so that their exports would also start to become very, very competitive. And along with others, Japan was forced to sign this agreement in the Plaza Hotel. So what really happened here? The value of Japanese yen shot up by more than 100%. Imagine the Indian rupee going from 80 rupees where it is right now to 40 rupees against the US dollar in a very small time frame. That is exactly what happened to the Japanese yen at this time. And what would happen when the yen starts strengthening back? It would mean that all the imports that the US is doing from Japan, it would suddenly start getting more and more expensive. But wait, why did Japan even accept such an agreement? Right? So what really happened here? There was external pressure from the US. There was internal pressure from the citizens who were getting rich all of these years. But when they're trying to import something into the country, into Japan, they found it very, very expensive. So the citizens also felt that if you're devaluing or if you're increasing the value of our currency against the dollar or any of the international currencies, our imports would start getting cheaper. So that was one thought that they had. And then there was also the large understanding or the large belief that with this extra added pressure on the Japanese companies, even in the domestic market as well as the international market, those companies will start to innovate and they'll end up making their products even better than earlier. And in turn, this would only be a net positive for the Japanese economy. And boy, were they wrong. It was the beginning of the end. So seeing that the exports have started or will keep on declining over the next multiple years, all of the most important people in Japan came together. The Bank of Japan, the government of Japan, they all came together and took the very strong or intelligent decision that they thought of reducing the interest rates in the country. What would happen then? If the bank's interest rates are set very, very low, these intelligent people who took this intelligent decision, they believe that all the companies will take these cheap loans and use it to expand their businesses and they'll be even more competitive. The research and development will be so heavy. Their new products, their expansion will be so fast that they can outrun this economic disaster that was in front of them after the Plaza Agreement. That is what they thought here. And the interest rates started getting cut. Between the years 1986 to 1989, the interest rate went from 5%, which is normal in a country, by the central bank, it went to 2.5%, which was lowest at the world at that time. And 1986 to 89, the prosperity continued. Right? They had managed, or Japanese officials believed that they had managed to avert the crisis. So 1986 to 1989, it was a period of again growth. Do you remember how we talked about the Japanese stock market going up by more than 6,000% between 1952 and 1985? But if you're expanding that a little further, between 1952 and the year 1990, the stock market kept on rallying. It was up by more than 24,000%. At this time, what was really happening? Yes, Japan's country and its economy only kept on growing, but at the same time, a lot of people who did not want or who did not need loans because of the very low interest rate nature of the economy, they started taking loans and started speculating in both the real estate and the stock market. Japan also kept on printing so much money that in 1986, they were able to buy 75% of all the US bonds up for sale in that year. Just imagine how many billions that would be. The hopes and dreams of the population was higher than ever. It felt like the party would never stop, and the excitement, even with the Plaza Agreement, even with any obstacle that Japan would have in the future, their growth story would keep on continuing. But in 1989, the same government and bank officials who had come together to take the decision of lowering interest rate, they started noticing this very weird phenomena. And they started digging in deeper what was really happening in the Japanese economy at this time. So when they went in deeper, they saw this very troubling fact. So they noticed that in the year 1969, which was 20 years ago, that the cost of all private land in Japan, it was nearly 14.9 trillion yen. And in 1989, in the present, when they were observing, they saw that the cost of land in the private sector had gone up to 2000 trillion yen. Don't even look at the exact numbers here. Imagine how much more it has increased because all the people started taking these very cheap loans and started speculating in the market. Imagine that at one situation, even companies like Nissan, they were making more money from speculating on land prices than they were making from selling cars. That was the situation of the country. And they decided, the officials decided here, hey, now is the time to end the party. Right? And in 1989, they started increasing their interest rates back very, very fast. And interest rates went back from 2.5% to 4.6% in 1989 and further to 6% in 1990. After that, it was all very quick. All the people who took money to get invested into the market, who leveraged their own portfolios, they were caught up in quite a bit of trouble. They didn't have enough money to go ahead and repay the bank. I've seen a lot of people do this in the Indian markets as well over the last years. But since the market went up, it was a normal or okay environment for them. And in the second case, where people took out money to buy assets like land, once again, the land prices crashed. And because of that, even the companies were in trouble. We talked about earlier, even companies were making money in their books and off their books by investing or speculating on real estate. So what happened to the workers there? You can imagine all the companies started going into losses and people started losing jobs. And you see what was happening here, right? Japan was meant to be the land of the rising sun. And before the entire world, the very thing that the US wanted to show off, capitalism as an initiative, it was completely failing in Japan. Land prices were crashing, people were losing their jobs, and because of all of this, banks collapsed, the stock market was crashing by nearly 65%, right? Imagine what that scenario was. And marking the Christmas day of 1989, which was the third interest rate hike for the year, everything just started falling apart. The land which was once talked about as being an economic miracle now started their lost decades. CEOs of major companies, they were holding press conferences. They were crying their eyes out because they had no other option, right? They had lost everything. Their companies had gone into absolute financial ruin. People had lost their jobs. And in Japan, it's a big deal. Once you join a company, it's like a family, right? And you don't necessarily or typically lose your job. But when these people had to do mass layoffs, they were literally crying in front of their workers. That was the situation there. So post 1990, what all happened? The market crashed and it never really bottomed out or started recovering until the 2008 global financial crisis. Imagine that is 18 years. Right? And after that, when you're looking at the economic growth of the country, it stagnated as well. So earlier we were talking about 10% annual growth. And between 1990 to 2000s, the country was experiencing just 1% average annual growth. And from the years 1991 to 2003, the GDP of the country, which was again the second largest economy at the time, even until 2010, the GDP grew at just 1.14%. From 2003 to 2010, it further slowed down to just 1% GDP growth per year. 2.12 lakh businesses declared bankruptcy in the country. More than 50 lakh employees lost their jobs and couldn't find a new one. Men in the ages of 18 to 44, suicide became the most common case of death in men. And these were the ground realities of what was happening in Japan. I know even I thought before digging very deep into the story, even I thought for some reason that Japan is a very happy country, that they are successful, happy, the people are happy, the government is doing really well. That is even what I thought before getting very deep into this. I just thought, okay, something happened with the stock market or some mishap happened with the economy where there was a bubble, but then there was no harm done. But no. In 1989, 32 companies out of the largest 50 companies in the world were Japanese companies. And today, it is just one out of the top 50, which is Toyota. Just imagine to what happened to all the other companies out there. and all the employees working in all of these companies. And now in 2024, we're seeing Japan slowly moving back up. It briefly even crossed the 1990 high, but it could not sustain. There were a lot of news articles when Japan fell over the last 1 month, right? The stock markets. But nobody even talked about how the Japanese markets were underperforming or was 80% down for multiple years. So now you know what happened in Japan, you know the why it happened as well. Now let's just take one other moment to just think about what was really the ground scenario in that situation. 2 generations or even more, they couldn't make any money. Right? There were no jobs. They couldn't make any money. Any money that they'd invested into either land or any other assets like the stock market, that had crashed completely. So they were out of money, right? People were literally, anybody who was going to retire, they were in big trouble. That was the economic situation that the country was in. And absolutely, that is a nightmare scenario. So that takes us to the next question. Can this ever happen to India? Well, as any logical person would say, it is not 100% right to say that this will never happen in India. Right? We can't say that. Nobody can ever say that. But I can give you a small saving grace here. The probability of it is very low. In fact, any student of economics, right, or any student of the stock market, as we are learning today, they should be knowing the fact that what happened in Japan. And once you know about this, most likely history would not repeat. It's a strong case study for all the reserve banks, not just in India, but other reserve banks across the country, right? I'm sure they're already learning about it. So such a situation, for it to repeat, I would say the chances are very less. And taking one moment to talk about our economic strength here, right? We are a very strong and independent democracy in the world. Right? We are not dependent on one such nation like how Japan was dependent on the US in the 1980s. We are not dependent on anyone like that. And hence, we do not even need to fear any external conflicts like the 1985 Plaza Agreement to come and mess up our economy. Right? So hope you understand that. Now, again, we have to go one layer deeper. Can a similar situation ever happen? Yes, we address that. Such a same scenario, the possibility of it to happen is very less. But can a similar situation happen? Let's say Japan was an intensity of 100. Can a situation where the intensity is 50 or 80 happen in India? Let's find out. To answer that question, there is only one thing. You have to understand how much power over our daily lives that the RBI and the government has. One bad move from the government or the RBI can mess up our entire country. Just think about it that way. This Bank of Japan's decision to move around or play around with their interest rates is what caused the bubble to expand throughout the 1985 plus 1990s. And from there, it started just getting worse, right? So similarly, RBI holds that power in our country. What Bank of Japan holds in Japan, Reserve Bank of India holds the same power in the country. They decide the key interest rates in the country. So what do you have to understand here? Each and every decision by the RBI is a game changer. You have to make sure that you're aware of it, that you're taking intelligent decisions based on each and every RBI move. And you, as a very responsible citizen, you should be exercising your strength of deciding who to bring into power, who the government should, who should form the government, who should the financial minister of the country be, right? If a party is giving their manifesto, right, we can demand them to have a finance minister in that manifesto as well. So who will that be? Is that person qualified? Is the RBI governor going to be qualified? Is the RBI keeping inflation in check? Are they keeping interest rates in check? So are they taking care of it all? Are they taking care of unnecessary loan growth, especially personal loan growth in the country? Again, these are points that I have seen the RBI enforcing upon people, right? They are actively looking into all of these points. So I believe they're doing a good job now, but we should make sure that they continue doing it. So inflation, money in the system, loans, especially given out to non-collateral based assets, right? And also the interest rate numbers. These are what the RBI has to have a keen eye on, and I believe they do, to make sure our country prospers over the long term. Just like how we said the RBI can mess up, that the government can mess up, and one small decision there can mess up the entire economy, people can also mess up. you and me, we can also mess up. So what are the things that we have to make sure? We as citizens, we need to make sure that we are contributing to the larger growth of the economy. With or without education, with or without government support, we all have to make sure that we are contributing to that larger economic movement in the country. The second thing is make sure you upskill yourself so that you're a valuable member of that economy. So improve your skills, or you can even create value by starting a business. And third and most important point, do not go on crazy loan fueled expense trips. Right? Expense trips as in not just literal trips, but let's say buying your most fancy like apartment that you can't afford, buying a crazy luxury sedan that you can't afford. All of this are basically over leveraging your life. Right? You don't have the money, you're taking leverage, right? As you might know, if you're a participant in the stock market, you're taking leverage, you're taking risks which are not needed, and you might end up in more and more trouble. So these are the things that the citizens have to look from our side. And I'm sure, or with whatever I'm seeing today, I have the confidence that the RBI and the government are taking care of their side. Right? We can still be good citizens. We can put pressure on them to keep making better decisions. And okay, let's come back. Adi, I hope you'll show the first agenda that we discuss here on the screen. So we discuss the first 3 points here. Now the only thing is a fourth point, which is what can you do to protect yourself from such a situation? As investors who are expecting 15 to 18% CAGR growth over the long term, just take a step back and really think, is that how you should be thinking about this game at all? Right? Yes, the equity markets can and might give this 15 to 18% CAGR, but the only way that you can truly protect yourself, especially as you grow up, as you age up or reach your retirement goals, right? It is to increase your debt exposure. I'm sure we have come full circle. We started with influencers, even maybe myself, maybe even Sharik, us talking about how 15 to 18% growth, just 12% growth minimum. All these are like very cool things to talk about, right? And then now we are coming to the very simple shorts, YouTube shorts that we have made, right? Which is 100 minus age rule. So as we turn older and we reach a situation where we'll be needing to live off the money that we have invested somewhere, let it be land, let it be the stock market, let it be anything, right? Even a startup investment. So at that point, you have to think about moving out money from all of this, moving out money from all these volatile assets back into very safe, very non-volatile assets like debt instruments. What does that really mean? Over the long term, you cannot assume 15 to 18% returns, because every year your returns will be reducing because your debt exposure will be increasing. But that is okay. That is the right way to do it. And I think that calculation and that discussion will be for another video entirely. And just to give a glimpse on how Japan is doing in the 2020s compared to India. The Japan's birth rate, the total children born last year was 7.58 lakhs. In India, 7.58 lakh children are born in just 12 days. Now it is up to us to make sure that it is being used as a valuable human resource and not as a trouble for the society. So that's it for the video, guys. Super positive. Really looking forward to the day where India really beats Japan and maybe even China and even the US to become the world's largest superpower. Right? I know maybe it's too over ambitious, but that's how we should be looking at it as well. That's what I believe. India really has the potential to do all of this. So that's it for the video, guys. Hope you like the entire concept that we discussed of comparing Japan's stock market, comparing it to the Indian stock market case as well. So do remember, even if you're invested into the Indian stock markets, that you do not go about expecting these crazy high returns for a very long time. In fact, we have done a video on this topic, which is the 3 biggest mistakes that mutual fund investors are making. I'll put it here in the I button. Make sure you watch that as well. If you like the video, make sure you hit the like button. Get subscribed if you want to watch more such content as well. This is Ajay Ajith signing off. See you all again. Bye-bye.